Well, hello and welcome to this webinar to discuss the PPF's annual Purple Book. Webinar Professional Pensions is delighted to be holding in conjunction with the Pension Protection Fund. My name is Jonathan Stapleton. I'm editor of Professional Pensions and I'm going to be your host for this session. The PPF's Purple Book, as I'm sure most of you know, is an annual survey of scheme finances that paints a holistic picture of the risks posed by UK defined benefit pension schemes that are protected by the PPF, giving us an idea of the latest trends in scheme de-risking, asset allocation and membership, among numerous other areas. This year's edition incorporates more granular asset allocation data collected by the pensions regulator, as well as a number of refinements to the PPF's own roll forward calculation methodology, which is used to estimate asset and liability figures. This webinar will be your chance to find out about the most recent edition of the Purple Book and to pose your questions to our panelists from the PPF. I'm delighted to welcome our speakers from the PPF today, PPF Chief Actuary and Interim Chief Financial Officer Shalin Bhagwan and PPF Actuary James Emmott. Welcome to you both. Before I hand over to Shalin and James to present some of the highlights of this year's Purple Book, I was hoping to ask each of them to tell us a little bit more about who they are and what they do. Shalin, can I start with you, please?
Thanks, Jonathan. Firstly, thank you all for joining. It's a huge privilege to be here this morning to share the results of the 19th edition of the Purple Book with you. As Jonathan said, I am the Chief Actuary and Interim Chief Financial Officer here at the Pension Protection Fund. Broadly speaking, that means I'm responsible for all things actuarial and finance, and have been working closely with my colleague James and others in the team to prepare this edition of the Purple. James.
Thanks, Shannon. Thank you, Jonathan, and Professional Pensions for having us. And good morning, everyone. Yes, my name's James Emmott. I'm an actuary in one of Shallin's actuarial teams here at the PPF. Must have been about 7 years or so. Prior to that, background in pensions consulting. And I've been sort of Mr. Purple, I suppose, for the last couple of years.
Well, thank you, James. Thank you, Shalin. As mentioned, we're going to begin with a presentation by both Shalin and James on some of the headline findings of this year's Purple Book. Before I hand over to them, I'd just like to remind you all that if you have a question to put to our speakers, please type it into the Q&A box. I'll put as many of those as possible to our speakers after their presentations. So without any further ado, over to Shalin and James.
Thanks, Jonathan. Welcome again to all of you that have joined this morning to listen to the latest results of the 19th edition of the Purple Book, which is really an acronym for the Pensions Universe Risk Profile. First published in 2006, the Purple Book is used by us at the Pension Protection Fund to help us gain a detailed understanding of the risks we face from the defined benefit pension fund universe, the claims we may face as the Pension Protection Fund in the years ahead, and it helps inform our funding strategy. As an example, most of you won't have access to the first edition of the Purple Book, but I'm lucky enough to have a hard copy on my desk, and flicking through it last night, I could see that there have been some major changes in the universe that we protect if we roll back to the first edition of the Purple Book, when there were 10,800 defined benefit pension funds being protected by the Pension Protection Fund. 83% of those were in deficits at the time. And the total deficit of those schemes that were in deficit was £76 billion. And that ranged between 2002 and 2006 between £60 billion and £130 billion. So giving you some idea of the kind of volatility that the Pension Protection Fund has witnessed since day one. Now, clearly, we face a much changed DB universe with less than 5,000 schemes contributing to this year's Purple some 19 years later. And as we will see later, the deficit of the schemes in deficit, the sum of those deficits, is down from 76 billion in our first edition all the way down to roughly 21 billion pounds. So some 70 to 75% reduction, not just in the proportion of schemes in deficit, which now stands at 26% versus 83% in 2006, but also that 70 to 75% reduction of the deficit carrying through in the actual pound amount of deficits that we face, but clearly with huge variability. And I think that's quite an important point to make. The PPF exists to protect schemes today, but for many decades into the future. Next slide, please. I'd like to draw your attention to a couple of key changes in the methodology in this year's Purple Book. Now, many of you will be aware that there's been an ongoing discussion between the ONS, the pensions regulator, and the PPF, and over the last while to see how we could better align the data that the market sees from these various sources about the state of the universe. Over the period since the last publication of Purple, we have received much more granular information about asset allocations that are prevailing in the defined benefit pension fund universe. This enhanced data, particularly around the bond allocations in those pension funds, has allowed us to update what we call our roll forward methodology. Our roll forward methodology, you will be aware, exists because scheme returns are naturally out of date due to the lag between schemes submitting returns and the date on which this snapshot of Purple is presented, which is the 31st of March 2024, and therefore some rolling forward of assets and liabilities is needed. It remains an approximate methodology, but the more granular the asset allocation data, the more we can get a sense of what roll forward methodology might be most relevant to the DB universe. And so updating that methodology has led to changes in the way that we see the funding level in the DB universe. We've also included estimates of cash flows into and out of schemes. In the past, Purple has been mostly concerned with funding levels rather than the absolute numbers of assets and liabilities, because it's the funding level of schemes that hurts us most, as the PPF, as opposed to cash flows in and out of schemes, where particularly benefit payments, as an example, will affect both assets and liabilities equally. So we've updated our methodology to take into account those benefit payments, and there's more detail in Chapter 4. We've also then had updated scheme status data. What this means is there's been greater validation of some of the pension fund data that's been submitted to TPR, and that gives us an updated snapshot of how many schemes are still close to a future accrual or close to new entrants, and I'll come on to that in a minute. Next slide, please. Now, as a result of the changes that have been made, we thought it important to preserve the trends within Purple, which are quite important to us, as well as for complete transparency to show the 31st of March 2023 numbers restated for those changes. Okay, and if we were to restate the 31st of March 2023 numbers, the aggregate Section 179 funding ratio falls to 120%, where previously we were reporting 134%, and the net surplus falls from 358 billion to 206 billion. And there, when you start from that restated position and you roll forward to this year's position, which is the part on the extreme right-hand side of this particular chart, you see a broadly similar picture has prevailed over the 23-24 year. But as I said, that is from the restated position. I mean, broadly speaking, what this tells us is schemes went into the LDI crisis better hedged, which is a positive, but of course didn't benefit as much from a rising gilt yield environment. So in the last year, what we've seen is further rises in gilt yields relative to the previous years, and some significant returns in admittedly small proportion of equity assets or growth assets still held by pension funds, which has led to the small changes that you see between, or the relatively smaller changes that you see between 2023 and 2024 purple data. Next slide, please. I mentioned the enhanced data on scheme status, and what we can now tell you is, using that enhanced data, 74% of DB pension funds are closed to new benefit accrual. Now, previously, that number, prior to updating for the enhanced data, would have stood closer to the 50% mark. So the picture is markedly changed following the enhancements that TPR have made to their data. And again, that's covered in later sections of Purple and by James. In terms of asset proportions, there's been another leg down in both the overall proportion of assets held in equity, down to now almost 15%, as well as another leg down in the allocation to UK equities. The overall bond allocations do, however, remain steady. James will refer to this a bit later, but overall bond allocations include so-called LDI assets, so overlays and unfunded hedging instruments such as derivatives, gilt repo, swaps, etc. And the final point I'd make on this slide is it continued to be another super year for the risk transfer market, with about £60 billion of risk transfer deals being completed, a record-breaking year for the pensions risk transfer market. I'll hand over to James at that point. Thanks, James.
Thank you very much, Shalin. Following your summary, following Shalin's summary, I'm going to talk through some more of the detail and the findings of Purple Book 2024. So first up here is the data that falls behind the Purple Book. For full information, please refer to Chapter 2 of the main document, and there's some more asset data information in Chapter 7 as well. But what are we looking at here? As Shalin's already mentioned, the number of schemes in the PPF eligible universe has dropped below 5,000. That's the 4974 in the top right-hand corner. And within that number of schemes, that's 8.8 million people that we are here to protect. 8.8 million is about the population of Greater London, I think, last time I checked. And in terms of where we get the data from, that's by the scheme return submitted to the pensions regulator by the effective date of Purple of March 2024. Within that, the Section 179 valuations will be lagged because it takes 15 months from their effective date before they have to be submitted. So there is a lag in the data. It's not as at March 24. It's 1 or 2 years old. Some are more, some a little less. And that is why we have the roll forward, because we need to get from that effective date of the 179 up until Purple. There's a couple of stats here on the slide and many more in Purple itself, but a couple of other things to sort of draw out. I ought to mention that perhaps 80% of the data is still pre the LDI episode from September 2022. So it is still quite difficult to draw many conclusions right now from the data that's there. And I suppose it's worth remembering, particularly in terms of the roll forward, that looking at when that data was and looking at now, the world is very different. When I say world, I really mean bond markets. We're rolling forward from a period of sort of low gilt yields to a period of high. So just sort of worth bearing in mind as we interpret the data and the findings. Next slide, please, Sophie. So in terms of scheme status, whether a scheme is completely open to new members and accrual, or whether it's closed to both of those things, as Shalin mentioned, this data is now subject to enhanced validation methodology by the pensions regulator. And And you can see that stark contrast as a result between 2022 and 2023. Indeed, the 73% for updated 2023 figures in terms of the proportion of schemes that are closed to new benefit accrual. Once that's updated in 2023, it's fairly stable, and a slight maturation as would be expected to 2024, and indeed 4% of schemes are open to new members still, as at 2023 and 2024. But what's quite striking about that, if we compare that to the second chart, which is the distribution of members by scheme status rather than schemes by members by scheme status, while 4% of schemes are open, 13% of the membership are in those schemes. 13% of 8.8 million, or just over 1 million, I think, which is the population of Birmingham, I believe. So that's because open schemes tend to be larger. So, as the PPF, we are here to protect those schemes, both, those people, both in those open schemes and in the more sort of de-risked, more closed schemes. Next slide, please, Sophie. Okay, so looking at the scheme funding, the funding positions, as Shalin has summarised, the sort of aggregate overall, all of the schemes in the universe overall surplus is this 219 billion. There are some schemes in surplus and some in deficit. Within that, about 26% of our 5,000 schemes are in deficit, and the aggregate deficit of those schemes is the 21 billion we highlight in the middle. Next slide, please, Sophie. And in terms of our reserves at the PPF, our funding position, our reserves are 13.2 billion pounds as of March 24, up about $1 billion from the year before, reflective of well-performing investment strategy over the year in between. And those reserves, while this is a snapshot at March 2024 of what the number is, these reserves are here to protect the universe of members throughout the universe's lifespan. And some more on that on the next slide. So indeed, what are our reserves there for? Per our funding strategy, and in particular, our maintaining our financial resilience, which is the current sort of status, current objective. The reserves are there partly to cover the risk of people living longer than expected, so more compensation needs to be paid for longer. And indeed, the reason that the PPF is here, the risk of claims upon us, priority 2 in the parlance. And then, of course, priority 3 reserves, which form additional protection for our members over and above those other 2 things I mentioned. Next slide, please, Sophie. And speaking of claims risk, claims so far on a cumulative basis, about the 9.5 billion mark, and it's been fairly flat for the last 3 years. You can see that flat purple line from about 2021 up to now. And while that appears a solid picture, we of course have to look at what might happen in the future, look at a range of scenarios to make sure that we're in a good position and remain so, and will remain so. So, for example, at the 95th percentile, in 10 years' time, there could be a further £6 billion worth of claims. So that, that's the sort of thing we have to consider when thinking about our reserves and the context of the universe. Next slide, please, Sophie. We've been talking about sort of the position at March 24, the effective date of purple. I must have said March 24 at least 10 times in the last 10 minutes. But what's happened since then? So up to October, bond yields are up, gilt yields are up, which leads to decreases in asset and liability values, and an slight increase in the aggregate Section 179 funding ratio from 123%, about 126. The deficit of schemes and deficit gone up slightly to 22 billion from a slightly smaller number of schemes, 25% proportion rather than 26. Schemes that are in deficit, some of them have different characteristics to the average of the universe, so they do behave differently. when rolled forward. And indeed, there are one or two sort of larger schemes in particular in that population that have wildly different characteristics from average. So, that's sort of one of the reasons why, the deficit hasn't moved in the same way as the numbers above. And all of this stuff will feature in our updated PPF 7800 index, which is due out next Tuesday. Within that, we've restated figures from March 23 for the new methodology, Shalin's mentioned, and indeed, as we do every year, the new data that we've got for Purple 24 features retrospectively there too, and that's from March 24 onwards. I've attempted to reformat it slightly, so hopefully you'll think it looks slightly nicer too when that comes out next week. Next slide, please, Sophie. And the final section of sort of detailed Purple Book information that I wanted to talk through is asset allocations, assets held by schemes. And through this section, the first 3 slides at least, start from sort of high level and then they drill down in terms of granularity as we click through. So this is the top level of splits, merely equities, bonds and other. And this shows that back in 2006, equities were over 60% of the proportion held, and that's fallen to 15% now in 2024, which is itself, a fair drop since the 19% last year. Bonds remain steady at around 70%, at least since 2020. They're sort of hovered around 70%. And I ought to remind everyone that this isn't just physical bonds, but this also features LDI that behaves like bonds, economically, in terms of economic characteristics, LDI that behaves like bonds, and that's per the instructions for the TPR scheme return, the questions on this, and how schemes are asked to input these categories. For this and for some of the detail in further slides, for more information, I would look at the TPR website. In the scheme return, there's the asset help file, which goes into all the categories and where schemes should put various investment types. Moving on, please, Sophie. So as promised, here's a slightly more granular breakdown. Bonds on the top, equities on the bottom. So the bond breakdown is via fixed interest gilts, index-linked gilts, and corporates. And if you look from 2016 to 2024, especially, it's not much change, fairly sort of static, around 20% in fixed interest gilts, 45% in index-linked gilts, and the rest in corporates. Equities, on the other hand, does show more of a trend. UK quoted equity used to be nearly 50% back in 2008, and has now fallen again to about 7% in 2024. So that's a clear sort of reduction in the proportion within equity held in UK quoted. Fairly stark difference there for private equity, going to nearly 45 from 30% last year, at the expense of the proportion held in overseas equities. Next slide, please, Sophie. And the deepest level of granularity, well, for bonds at least, and when we talk about the new granularity that's in the TPR scheme returns and the extra asset information that we have and that we use, this is what we're talking about, particularly for bonds. And I'm not going to go through every number in this table. It featured in purple for the first time last year, but I thought I'd bring it out in the webinar this year as well. So what you've got is a more granular breakdown of corporate bonds plus private debt, and then within some of those, breakdown by duration, short, medium, depending again how they're categorized in the scheme return, or long dated. Long dated means 15 years or over for gilts and 10 years or over for corporates. And I think unsurprisingly, this shows that long dated gilts predominate, which when I say it's unsurprising, that's because of the nature of DB liabilities, really. Next slide, please, Sophie. And finally, not a different stage of granularity this time, but rather a different way of slicing the data, this time by scheme asset size or by scheme status. So the top chart is not new for purple, except in the bond half on the left, we've split out corporate bonds, or not corporate bonds, the private debt part of corporate security, because what we want to show is that as asset sizes get larger, scheme asset sizes get larger, the left-hand bar is schemes less than 5 million assets, and then over 1 billion on the right. What we see is that the larger schemes have more in private debt. And then if you compare that to equity on the right-hand side of that top chart, you can see that that's true of private equity. Schemes with over 1 billion have over half of their equity holdings in private equity. So the conclusion here is that private security in general, more of it, big schemes hold more of it. And last but not least, a brand new chart for purple this year. We've been asked, I think more than once, over the last year since publication of Purple Book 23, for an asset allocation by scheme status. So we've put that in at the end of chapter 7. So you've got open schemes is the bar on the right, and then closed benefit accrual. Open schemes are on the left, closed benefit accrual on the right. New members, but open to benefit accrual in the middle. So open schemes have over 40% of their bonds, of their assets in equities, and then while the bond proportion is fairly similar between the two levels of closed schemes, closed to new benefit accrual do have more annuities. There's that 13 versus 6%. I don't know how visible that is, but annuities is 6% in the middle and 13% on the right. So again, not surprising that sort of as the schemes close, less in equity and more in bonds and annuity. And that is all I wanted to say about that. Thank you very much. Back to you, Jonathan.
Well, thank you very much indeed, James, and thank you, Shalin, for your presentations. We now move on to the Q&A part of this webinar. Questions already coming in. If you'd like to add to that question list, please go to the Q&A button at the top of the screen and then ask your questions there. If you want to upvote a question, click the up facing arrow underneath the question and that will vote it up on the scale. So please do get your questions in. If I can start off, please, Shalin, can I come to you? Are you happy with the current net funding position of the DB universe? What do you think that means to schemes, members, and indeed the PPF?
Shalin, you're on mute.
Thanks, Jonathan. There you go, schoolboy error on a Thursday morning. When you asked about sort of introductions, I should have said, I should have probably said, I come from my background is really having spent a lot of time at various asset management firms trying to hedge interest rate and inflation risk for some of the largest corporate DB pension funds in the UK. So, we've got the scars on our back in terms of how volatile and difficult a journey it has been for UK corporates to get to this point. So, I don't know that I ever imagined that we would get to this point in terms of funding levels for corporate DB schemes this quickly or this fast. And I don't think any of us did imagine it. But now that we're here, it's a hugely comforting position. I think it's important, however, to recognize, as we've been trying to highlight throughout this presentation, that volatility remains, and the PPF exists to protect pension funds over many decades into the future. And so you can't not be happy with the current snapshot of the corporate DB universe. And, it's quite, I think this just brings into heightened focus the importance of sound endgame planning.
Thank you so much for that, Shalin. I'm going to move on to some of our audience questions. One question here talking about the size of the surplus in DB schemes, 219 billion Section 179 surplus. To what extent, our questioner asks, is sort of the pension system overfunded at this point?
Look,
James,
I think
Shalin, if I'll come to you first, Shalin. Obviously, Section 179, not a buyout basis, isn't it?
There you go, Jonathan. You've just taken the wind out of my sails. No, I'm joking. Look, obviously, that's absolutely spot on. Look, I mean, we recognize, I think this is quite important, and apologies, perhaps we should have stated it more clearly up front, but, most schemes are not funding to Section 179. Obviously, when you look at Section 179, it tends to present a rosier picture. I guess if you were to adjust, we do have some estimates of the buyout position, and that sort of looks to be more in, depending on how you slice the data and which type of scheme you're looking at, you probably have an estimated buyout position in between 90 and 95% for many schemes. There is some variability in that. Most schemes will be funding towards a higher, wanting to pay full scheme benefits, as well as potentially in some schemes cases target buyout or potentially run on.
Thank you very much indeed. Coming to another question, a more technical question on the data, I think. James, have you updated the funding figures on a buyout basis, both to update 2023 and the new figures 24?
Yes, we have, and those can be found in Chapter 4 of the Purple Book. I believe Shannon just quoted 90 to 95% sort of funding level. The aggregate funding level is about 95%, and about 30% of schemes appear overfunded, per the data and their estimation. I would just take the opportunity to point out that here at PPF and for the Purple Book 7800, S179 is our thing. What we deal with is our sort of bread and butter, and for buyout we are necessarily sort of converting that 179 into what buyout might look like based on sort of the data that we have on the original scheme increases, undoing the 90% cutback and things like that. So I would bear in mind sort of the level of estimation that necessarily goes into that. But
if I may just add to that, I would just come in, and again coming back to the previous question, I think we can't help but recognize that, and I'm certainly not trying to avoid the fact that there are some pension funds that are in surplus, and I think the question was designed to potentially talk a bit about the potential over allocation of capital, and how do we, as an industry, think about surplus generation going forward. Those are valid questions. I was at an Endgame conference, talking about these issues. I think this topic is a live discussion between advisors, independent trustees, and sponsors of DB pension funds, and it's clearly a hot topic and one that has complex challenges associated with it.
Thank you very much indeed, Shalin. Thank you, James. Please do keep your questions coming. We will get through as many of those as possible in the next 10 or so minutes. So another question here, James, I think it's another one for you. How has the number of schemes in wind-up changed between 23 and 24, and are you seeing the impact of increased buyout activity in these numbers?
I think the answer is it is up slightly. In these bars, the huge chunk is the other statuses, and there's a little sliver at the top that represents wind up. So it is often hard to sort of see what that difference is, but it is up slightly. And I think the source of the question is well, that would make sense, isn't because with as more schemes buy out, then they would wind up before they leave the universe. Again, there will probably be a bit of a lag in the data here. So for stuff that happened in 2023, it might not all of it will show up in the data yet. And if some schemes manage to fully wind up and disappear, then well, they'll have wound up and they won't even be in the universe anymore, rather than in the universe, but with a status of wind up. So yeah, so I think we'll see it come through in that way. Perhaps worth pointing out that the 60 billion of risk transfer deal activity in 2023 is only around 5% of the size of the universe, sort of suggesting that PPF still has a role to play in protecting the universe for many decades yet.
Thanks so much, James. Shalin, you talked a little bit about the wider debate on the future of DB schemes. How do you see the sort of this year's Purple Book data informing that wider debate?
Well, I think what it says is that schemes are in a much better funded position. We see the bond allocations constant at about 70%. We still lack sufficient granularity of data, I think, in terms of what that means in terms of just how well hedged the universe is for interest rates and inflation risk. I'm not for a moment suggesting we would ever return to the lower yield environment we had pre-2022. However, it is something that I think most pension funds are thinking about: is what is the level of hedging? How do you take risk while mitigating risk at the same time? So I think the picture suggests that we've arrived at a favorable point in time. How do we think about asset allocation in this environment? How do we mitigate downside risk while still retaining the potential for upside? But in particular, for those schemes that are not yet fully funded, potentially on a buyout basis, if that's their end game plan, or alternatively trying to invest their surplus productively.
Thank you very much indeed, Shalin. We've got a question here. James, I'm going to put it to you, if I may, please. Is the pound amount asset amount based on Section 179 valuation submissions only and then rolled forward, or is it recalibrated to the asset value given alongside allocations and rolled forward from there? So to throw you, it's quite a technical question, I think, but one I'm hoping you might be able to answer.
No, thank you, Jonathan. It is the latter, namely, yes, recalibration for the updated asset allocations, and the person asking the question is absolutely right. We get the 179 valuation information, and that gives the value of the assets, and then the report and accounts, audited report and accounts, later date, often to the 179, has an updated asset allocation in it, and again, that's a question in TPR's scheme return, and that data flows through to us. For more information on how that looks, and how many schemes are in what age in terms of how our asset proportion is and how our Section 179 is, there's the chart at the beginning of Chapter 2 for the 179s and a chart at the beginning of Chapter 7 for the asset allocations.
Thank you very much indeed. Thank you for taking that, James. Shalin, if I can come to you, please. We have obviously the revised methodology looking at, and there's been the broader debate about aligning sort of PPF, TPR and ONS data. How do purple figures to DB assets in March 23 and 24 now compare with ONS figures? And I think more broadly, can you sort of just talk about some of that, sort of more broadly talk about some of that work aligning figures and how you're sort of maintaining the integrity of the Purple Book data?
Yeah, so I think, James, I'm happy for you to take the ONS asset data. I mean, I think I have the numbers in front of me, but go ahead.
I was just going to say around 1%. is the difference at that date between the ONS asset estimate and ours. I do want to highlight that it won't always be 1%, and these things will fluctuate over time, and we will be monitoring that and making sure our our roll forward sort of continues to work. It's fit for purpose. But and it is it is worth again sort of pointing out that these are estimates. You could, if you've got all 5,000 schemes in a room one day and then added up their assets at that day, there's a number. That's what the ONS is trying to estimate. That's what we're trying to estimate. And we go about it in different ways. The ONS does the survey and scales up. We look at all the schemes, but then we roll forward. But TPR does something very similar. Essentially the same, but with some differences to how they model. Yeah, as and as you say, how has this come about? We have been sort of talking with TPR and ONS, to sort of really truly understand the nitty gritty of how each organisation comes up with its estimates, and align ourselves where appropriate to do so.
Thank you. Thank you.
I might just add that since I've joined the PPF, which is about 18 months ago, I think we've tried to meet with certainly with the pensions regulator a lot more frequently, and there's a lot greater exchange of information. I mean, obviously, both organizations are going. The entire industry is going through a massive change. I mean, following the rise in funding levels, and therefore it's natural that TPR and both TPR and PPF will be thinking about how to set ourselves up going forward. So I would say there's a lot more interaction between the two actuarial teams, and therefore we're confident that we can continue to maintain the data sharing that goes on between the two organizations in order to ensure that the data that comes to the schemes through Purple is a lot more connected to the underlying data that TPR get. We don't see all the data that TPR see, but there's a lot greater sharing of information going across the two organizations.
Thank you very much indeed. James, over to you on equity allocations. In your presentation and indeed in the Purple Book itself, there was a marked increase to private equity, but a further reduction in UK listed equities to, I think, a record low. What do you think is behind that?
So I confess I don't know for sure why, but if I were to speculate on the private equity side, I think there's the possibility that during the LDI episode, as schemes were, if they had to sell assets quickly and at a decent price, in order to come up with, in order to get some cash, private equity wouldn't be the first thing you'd go to. You can't just sort of sell those immediately. So if equity did have to be sold, you'd have to start with your public listings. And since schemes have more in overseas than UK, I guess you would start with your larger purse first.
Thank you very much indeed for that, James. Shalin, coming to you, I have to ask the levy question. How will this year's data inform your future plans on charging levy?
I think so. There's a few things here. I think it's quite important that we understand that the PPF's funding position needs to, the 13 billion pounds of surplus, which James alluded to, and hopefully the point was clear on the slide I presented, that 13 billion pounds exists to protect against a number of things. The first thing it protects against is the volatility in the liabilities for transferred schemes, which there's uncertainty in the estimate due to longevity risk. The second thing it protects against is the claims risk, which is our priority 2 reserves in the chart that James showed you, which, as we can see, some of the deficit of schemes in deficit today is 21 billion, but with a huge degree of variability potentially in the future, depending on how well schemes are hedged for interest rate and inflation risk, and then potentially longevity risk, looking much further out into the future. So in terms of the levy conversation, I think the PPF's position on the levy has been, we've been quite transparent on this, that it is important for us to see some changes to the levy legislation, which would allow us to have more flexibility in the way that we charge the levy. As everyone on the call probably knows, if the PPF were to charge a zero levy, it would not be able to bring a levy back. But we are mindful that, of our levy payers, and we continue to work with all the stakeholders and policymakers who have the ability to influence the necessary changes that are needed in order for us to be able to reduce the levy. But ultimately, it's not it's a board decision, and that's for the PPF board to decide. So I think where we end up going forward is continue to talk to levy payers, continue to talk to policymakers, and attempt to find a way forward in order to get more clarity and certainty for the DB endgame. And I think it's quite important for all of us to have our focus in 2025 on what policy changes are needed for us to get that certainty.
Thank you so much, Shalin. One quick question back to you, James, if I may. To what extent does the Purple Book look at sort of the number of schemes that have bought in? Is that something that's shown in the data, and indeed schemes that have bought out? I know by the time they wind up, they will no longer be in the data set, but is there any sort of data on that within the Purple Book?
Yes, indeed. On my last slide, when I was talking about annuities and how there's a high proportion between schemes that are fully closed rather than only to new members, and there was a little sort of lime green category, that is mostly to do with schemes that are bought in. If the scheme's still there, but just with sort of the buy-in policy, then we are still here to protect that scheme, so they remain in the universe.
Thank you very much indeed. I'm afraid that we're getting to the end of our webinar for today. What are the key points you would like to leave people with today? James, can I start with you, please?
Thank you, Jonathan. Thank you, everyone, for your time having us this morning. So we hope that the refinements and the results that they show are helpful, but we would sort of just caution, please still be mindful in comparing figures between different organizations, because the purposes are different, the estimates are different, sort of data collection it can be different. And as I alluded to more than once, there are a couple of new charts in Purple, or where the chart's the same, that they perhaps show slightly different things, or some new data on a similar chart. So again, I hope those are helpful, and readers will find those to be interesting additions and improvements.
Thanks so much, James. And Shalin.
Yeah, thanks, Jonathan. So two things. I think I speak for both James and I when I say we feel incredibly lucky and privileged to be able to steward the Purple Book into its 19th edition, and we never take that privilege for granted. So it's quite important for us to continue to produce a high quality publication, and I hope you feel that we have done that this year. So including the fact that we have tried to provide full transparency where we have restated figures in order to preserve the comparability of the Purple Books from year to year. So that's the first point I'd like to make. I think the second point, which is a much more system-wide point, it strikes me that the current conversation, and it comes back to an earlier question, Jonathan, you asked of me, how do I feel about the state of the DB universe? I think we all have to feel really positive about the place that we've gotten ourselves to. We can think, we can talk about whether some of that is slightly fortuitous and not due to our own making, but nonetheless, we find ourselves at a pivotal moment in the DB universe. we at the Pension Protection Fund, are here to play our role and support the journey of defined benefit pension funds, whatever their end game strategy. And I think what is quite important to take away from this is that end game planning becomes even more important if we are to ensure that the DB universe uses or grasps the opportunity that we now have in order to ensure an orderly runoff of the defined benefit pension fund liabilities in the UK.
Shalin, thank you so much for that. And James, thank you as well. I'm afraid that's all the time we have for in this webinar. Thank you again to our speakers, Shalin Bhagwan and James Emmott, for taking part. And thank you to all of you for listening in. Please do join us for our next webinar soon. Thank you very much indeed.